been a lot of discussion in the industry. So I will welcome Eva Stolz to bring up your panel and take us forward.
Can you hear me? Yeah, perfect, okay. First I'd like to invite our panelists on the chairs here. So Arno, Vashikala, Doseki, and Henrik, please join me. I'm very excited to hearing the panelists on our next topic, which is the future of off-grid solar. And before having them introduce themselves, I'd like to share some of the insights and data from the latest market trends report from Gogla, and also from the discussions that we've had in Kigali just a week ago. So some of you may have been there, so for those, bear with me. I hope you might have heard some of that already, but I'm hoping that there will be also new insights and new discussions in the next hour. So as Persistent, we have been one of the pioneer investors in the sector, and we've invested in a number of companies starting about 10 years ago. Besides that, we've also continued to be a thought leader in the sector, publishing some of the papers, for example, in the very early days about the business model. Then just 2 years ago or so, we went back to that, looked at what assumptions had we made back then, and which of these assumptions have come true and which haven't. And this is definitely a sector that we're looking forward to continue to supporting further. So far, the off-grid energy sector has reached about 490 million people. This is a massive success. However, there are still 733 million people around the world that lack energy access. And 550 million of those are based in sub-Saharan Africa. So we've come a far way, but there's still a lot to do. The vast majority of the customers in the sector, as many of you will know, they're not able to pay the cash price of these products. And so basically, end-user financing remains key in the space. However, the sector, despite having been a massive success in terms of providing energy access, there are still a lot of challenges, and it's still in its formative years. So one of the key challenges that we've talked a lot about, and we've also written a paper about, is the lack of profitability, or the longer time it takes to profitability than we had anticipated, essentially. And we've also seen many companies exiting the sector. We've also seen companies struggling, which has obviously discouraged the flow of capital, especially equity, into the sector. Many companies have a high level of debt, but there is an equity shortage. And there are innovative ways that are being developed, for example, off-grid balance sheet facilities. But so far, these transactions are very costly for for smaller companies, and mainly accessible to the large companies in the sector. And as we all know, there have also been a lot of external shocks in the sector in the past years. The pandemic, droughts, which have impacted the customer's ability to pay, but also increased expenses, for example, on the supply side. When it comes to financing, based on trends and future projections, the sector is going to attract 7 billion in financing until 2030. This is 15 billion short of what is needed to reach universal energy access, SDG 7, which is basically clean and affordable energy for all. There are, of course, also a lot of opportunities in the sector. A lot of the companies we'll hear about, they've built a large distribution network, they've built technology which can be leveraged for services beyond energy. For example, smartphones or other consumer products. Productive use is a big topic as well, which has become more efficient and more affordable. So this is something that we'll also see having a large impact on the sector in the years to come. Then there's also, especially when it comes to reaching remote and rural customers, supply-side subsidies and consumer subsidies that continue to be available to make sure that we don't only capture the part of the market that has the ability to pay for the products themselves. And then I would say the last one there was also quite some discussion around is the whole origination of climate finance. So basically an opportunity for additional financing that can be attracted to the off-grid energy sector. Just one last point. So the panelists that are sitting here, together with their companies, with their teams, they have provided energy access to more than 3 million people, which I think is a reason to celebrate. And yeah, now I'd like to hand over to, I think the first is Henrik from Azzurri for an introduction of yourself and your company.
Can you hear me? Good, yeah. Nice to meet you all. Good afternoon. Nice to be here on the stage with such a nice crowd of people. Yeah, so my name is Henrik. I know quite a few faces here in the room, so nice to see these people. Yeah, I've been around in East Africa for the past 10 years or so, of which some 7, 8 of them in this sector. As much as it's hard work, there's something in it that really keeps me waking up and wanting to crack this difficult business model. I'm with Azzurri for the past 3 years or so, and yeah, I think most people would probably know Azzurri is not an company that Persistent has worked with per se, but there's a relationship, yeah, we've been selling some 250,000 units across Africa, core markets being here in Kenya, as well in Zambia, and presence in Nigeria. And I think talking about different experiences and where we are on that journey. We decided, at least for the East African side and here in Kenya, we've decided to wind down our operations here in Kenya. We'll come back to the details around that, but on the Paygo side, so it hasn't been making sense for us to continue doing that. But we're now looking into the next phase, bigger systems, backup systems, and with a focus on Nigeria. We'll see what's next for East Africa, but that's me in a nutshell. I'll talk to my experience predominantly from an operations and commercial experience. So I've been on the ground, as I said, running, shaping and running the business day to day, and also the expansion side of things, as you set up and just, I guess, build and shape the ventures that these guys with the Persistent folks are experts in. So that's my background.
Thank you very much, Henrik. I'd like to invite Oseke to introduce Olu and herself.
So hello everyone. I don't know if you can hear me. So I work with a company called Ulu. Ulu is an SHS distribution company. We try to provide electricity to people that are off-grid or in low-grid areas by selling renewable energy products. We're currently in about 6 countries, Senegal, Nigeria, Burkina Faso, Niger, Cameroon, and Mali. And our model, our vision is really that if you can provide the energy, people can change their lives. It can change how much they earn. It could impact their livelihoods. If they just have access to energy to run their businesses, people don't necessarily want to be dependent on other people. And so we believe that providing that access to energy at multiple levels across different customer stratas is important to us as a business. We make reliable solar home systems. We partner with multiple people to be able to listen to the customer, listen to the market, hear what they need, and then produce products that match our customers and what exactly that they need in terms of that. We have connected over 66,000 households, connections, deployed systems across Africa. And you have the stats there. We have over 300 full-time employees across all our countries. We're impacting different households in Africa. We run surveys, and 90% of our customers, fingers crossed after COVID and stockouts, they're happy with what we do. Ulu was founded again by Nilmi and Dan, and they've grown the business and have been able to sell that vision and idea to us that have joined and believe in it and continue to drive it. What's the next one? Anyone? Oh, okay. So it's important, and I know someone was asking about KPIs for ESG. So one of the things we struggle with, sometimes you get distracted with, after you've raised funds, you've raised money, you're trying to meet obligations. So one of the things we try to do is that we also include ESG and CSR targets in our business. We partner with corporates to serve communities. So we would go to poor communities that ordinarily would not be able to afford our systems and partner with a corporate organization to serve that community. That's it. In Nigeria, we're covering about 70% of the country right now, and we're looking to continue to grow strong. Thank you.
Thank you very much. Washikala, can I hand over? But it would be great if you could...
Yeah, okay, thank you so much. My name is Washikala, Malang Washikala. I am co-founder and CEO of Altec Group. Altec Group has been working in the Democratic Republic of Congo for almost 9 years now. We started very, very small in Eastern Congo, in a small town called Baraka. It is located on the shores of Lake Tanganyika. Ongo and I piloted the distribution of thousands of solar lights and working with households, but also schools and health centers. And then, after realizing that this was a model that could work, we decided to scale up across the DRC. We are currently operational in 26 provinces of the DRC, and we hope to be able to reach all 26 by the end of this year. Talking about the DRC, when you talk about the DRC, a lot of people think about the challenges that they hear a lot, but this is a very interesting market. We are talking about a population of over 100 million now, and a country with one of the lowest electrification rate in the world. So we are talking about the market energy. DRC is one of the, important energy access markets in Africa, because, we are talking about 70 plus million people who do not have access to electricity. And one of the, another interesting thing about the DRC market is that, unlike other markets where this sector has been focusing mostly on rural areas, I think in the DRC it's different. It's both urban and rural. So it's a very important market, and that presents a lot of opportunities in spite of all the challenges, definitely, that people hear about. And definitely those challenges are opportunities anyway. Since we started, we have been able to sell over 300,000 products. We have been able to reach 1.5 million people. We have been able to avoid 320,000 tons of CO2, and we have made 10 million in profit cumulatively. And definitely since day one, this has been able to be achieved based on the fact that we focus on 5 key business principles, I think. One is providing best products to our customers. It's true that there are a lot of solar products available in the market. In every market you go, there are a lot of products. But one of the things that we have focused from day one is to make sure that we are providing our customers with the best that is out there. I even joked yesterday when we were having a meeting somewhere that, the days where, solar products were being almost, compared, with a candle and the kerosene lamps are gone, off-grid customers deserve the best, so definitely this is one of the things that we are focused on. Another important element is making sure that we have best customer services. Whatever quality that a product has, sometimes will face some issues, and we have built a network that really provides, fast customer service. We are, I think, one of those few companies, if not the only company that provides free repair services throughout the lifetime of the products. So, customers do not have to worry throughout that. Whenever happens, they come back to our shops and we offer those free services. And we have done that across the DRC. Another important element is portfolio quality. I always say selling products is good, but definitely, especially when it comes to Paygo Solar, the real work comes after selling. So you have to make sure that you keep collecting cash from customers. So we have used both technology and community-based approaches to making sure that our portfolio quality remains high. I think this is one area that the industry has to really focus on because there are a lot of challenges now, a lot of discussions around that, and we really understood this right from the beginning that this is one area we'll focus and maintain the highest portfolio quality that is there in the industry. And definitely another, the other area where we focus is making sure that we reach as many people as possible. We have been scaling in spite of the infrastructure challenges that DRC is known for. We have been able to scale, as I said, in 22 provinces and working so hard to make sure that we are in 26 provinces by the end of this year. This means also these will enable us to maintain our revenue, high revenues, but also, we provide a range of products, from entry-level solar product to solar generators, and in between we have different solar home system offers with appliances. And but not least, there is also the issue of profitability, as I've been saying. It's very important, especially as we have to attract a lot of investors in the sector. It's very important that we work so hard on profitability, and that was our main priority since day one. So moving forward, definitely we are continuing to scale our pay-as-you-go solar, but also we are already working on different other opportunities, including e-mobility, as we talked about earlier, but also focusing, we have what we are calling productive use, but also solar-powered distribution of clean water. All of these growth opportunities we see in the DRC that we are exploring already and working on.
Thanks very much, Washikada. Arno, last but not least, could you please introduce yourself and SolarWorks?
Yeah, although looking at my neighbor's figures, I think you can do the future of this sector on your own. So that's very impressive what you showed there. But yeah, so I'm Arnoud. I started SolarWorks a long time ago, 2009. We used to be a product company and branched into Paygo in 2016, 17. So we are not a full-on Paygo company anymore because for most people maybe the pandemic was the first hard hit, but we were hit by a cyclone in Mozambique. So we operate in Mozambique and Malawi. And that washed away about 15% of our system. It was gone, right? I just heard a lawyer say that we should have declared force majeure. I don't know what it is, but she said that is what we should have done. But so that was gone, right? And it's very difficult to then get up again. And when we did, we were hit by the pandemic. And when we recovered from that, we got all those supply chain issues. So we said, look, we need something that generates cash because we cannot just be praying for a normal year, right? So when the pandemic hit, for us that was the second big thing. So that's when we started to electrify hospitals, schools, residential areas. So we now have systems that we sell for cash or through a bank. So the bank takes on the loan and we sell for cash. So that's a big change since, I guess, April 2020 when we got our first bigger system contract. It helped a lot also that we had a big utility as shareholder. They had a lot of knowledge on bigger systems. So, but that's basically the summary of this picture. So Mozambique, just quickly, the first year was 2017 and 2022 was what 2019 should have been roughly, because 2019, 20 and 21 were very tough. Still, we are for a year now, since Q4 last year, EBITDA positive on group level. So things have really, finally, they are happening for us. Yeah, so look, we can go to all these numbers, but you can see the change. I think the biggest message here is that 2022 should have been 2019. So Malawi is a completely different country, which is, I think, also important for those who are in several countries to understand that, like, you cannot compare Germany with Italy. It's the same as everywhere in the world, right? The one country has a completely different way of consuming, eating, living their lives, basically, right? So we saw that in Malawi, but Malawi for us has turned out to be like a real star. So very good collections, very good sales, very low operational cost. It's a small country with 20 million people. So yeah, very, very happy that also there 2019 was the start. There was election trouble, but okay, we got through it. 2021, same issues, the pandemic and the things. So 2022 should have been 2020 in this case. But look, I don't complain. We got every time we got up and came out stronger in the end. So the last thing is a video, I think. Yeah. Yeah. So one of our employees. Can you stop it before? Is there sound? Can you go back to the start? So I just want to say something. So I'm sitting here and usually sitting in a really nice office or in a really nice hotel, but it's always good, I think, to realize what happens every day in the field, because it's such a tough job, and it's so easy for us all to say, you need to do this and you need to do that, and but then go out there in the dust, in the rain. Try to sell solar in the rain. It's not easy. Huh? It's not easy, but we ask it every day. Well, not every day, but you have a couple of months that the weather is really bad. So, but these guys keep on going. So I see this video. It's shot by somebody with his cell phone in the field. So it's a bit of a tribute to the people that they actually make it all happen. Huh? Because it's definitely only partly us here. Is there sound?
So we had the sound, but they had to disconnect it because of some...
There's no sound, there's very little...
Let's just 1 second.
Okay.
Yeah, otherwise we can also dive into the questions and then go back to the session.
Yeah, well, is there sound?
There will be sound, we just wait.
Okay, all right. Okay, fine.
Yeah.
Yeah,
Okay, great. Then I think we'll end the session with the video.
yeah, sure.
Yeah, we've heard a little bit already about how the pandemic affected you. I'd be interested to hear what have been the effects in a negative, but perhaps also in a positive way, and whether you still feel the effects to date. Doseke, I'd like to start with you commenting on that.
Okay, so the pandemic, we thought we were going to be decimated by the pandemic. And I think when the pandemic started, we just said to ourselves, plan for the worst case. And our goal was to ensure that the business was surviving, in 6 months' time. And so we deliberately took cuts, decided to make cuts in the business, especially at the executive level. We applied cuts in terms of remuneration. Our goal was to just make sure that the business would survive in 6 months. And we felt that if the business could survive in 6 months, then we had a fighting chance. But we're pleasantly surprised because when the pandemic started, everybody was at home. Kids were at home. And if the power situation has not been solved, they are sitting at home, 12, 14, 24 hours a day. So imagine children, right? 24 hours a day, they can't go anywhere, no TV, nothing to do. And so what that did was that it actually, we probably made our largest revenue at that time during the pandemic because people were at home, they needed power. The problem of electricity had still not been solved. She mentioned how many people are still without power. So the addressable market is there, right? And so for the pandemic, that really showed us that the opportunity is there. And if we could get the right model, that we could actually build on what we had done. So that was a pleasant surprise in terms of the pandemic. But at the same time, it also reduced the quality of our portfolio. Because as you can imagine, people were not working, people were not earning. So it was important. I mean, they couldn't pay as much. They knew they wanted the lights on, so rather than pay for 30 days, maybe they'll just put a little bit and we give them flexibility in terms of how they paid. So it just meant that the quality of our portfolio during that time or the rates of repayments were a bit lower than what we expected. During that time, we had to also offer our customers, free energy credits during those times to support them, but also to just ensure that they're engaged with us. They don't just turn off the device and the device was off for a long period of time. So that was our experience in terms of the pandemic. It put a lot more pressure on the business. Portfolio quality, the repayments sort of dipped as well, during that period. But it also showed resilience for the business, and it showed resilience from an internal perspective and also from an external perspective. Unfortunately for Nigeria and some of the countries in which we operate within, we went into an economic downturn as well. So even when we came out of the pandemic, you still had inflation, high cost of living. People are going through that now. And so people are reprioritizing. They started reprioritizing how they spent their money. So if your kids are hungry, if your family is hungry, you buy food rather than pay for your solar. And so we continue to see that even as we continue. But the opportunity is there. When you look at in Nigeria, for example, and maybe some neighboring countries like Ghana, the cost of diesel has gone up by 300, 500% since the beginning of the year. The cost of petrol has gone up again by about 20, 30%. So the alternative sources of energy is even becoming more expensive for people that normally would use it. And that in itself provides the opportunity. And I think the key would be to find the right model where it continues to be affordable and people are able to acquire those assets, use those assets over the period of time. Thank you.
Very much. And to all the panelists, based on the experiences that you've had and where you are now, how do you think the market will evolve in the current economic environment? What do you think are some of the next challenges, but also opportunities that the sector will have to tackle? Arno, do you want to start?
Well, you make it sound like this is a tough year, but for us,
it's a tough year.
but for us particularly, this is the first somewhat normal year, right? We had months and months that we could hardly get stock last year. In 2020, people couldn't even leave their houses, also not our salespeople. They were not allowed to go to the office, all of that. And before that, we had all of our offices being shelters because of the cyclone. So this is a great year. I don't see any issues, really. In terms of, there are challenges in general in the sector, but I don't know, maybe we can talk about that later, but I sometimes think we're forgetting what is actually happening here. So instead of focusing so much on profitability, which we all know needs to happen, the movement or the change from how energy was used in the past and how it is being used now is not going to be reverted. This is going to continue. And this market is basically unstoppable, right? So, which makes it even stranger that there is so little equity versus debt, because this is now really the market where you should put equity in. But maybe I'm jumping a little bit to my hobby horse here.
No, I think that's great to hear, and I'd like to continue on that note. So you mentioned there's a lot of opportunity actually in the sector as well.
Yes.
And I'd like to hear a bit more on that. What do you see as some of the next things that the sector will, the next goals that the sector will achieve, the next topics that the sector will address? What do you see as some of the major opportunities?
For me?
You can,
Yeah, so equity is one. It makes no sense to me that that everybody is, they're literally calling you if you want debt, right? Whereas the market, I would say, is more fit for equity. So that's one. And then I think, if I look at our countries, there is really not one fit-all solution. Like in Malawi, for example, small systems have never really worked. We only do larger systems there. It's going extremely well. Whereas in Mozambique, we have these subsidy programs until the end of 2025 confirmed. You would be crazy if you would then say, look, we're not going to, we don't do small systems, right? So I don't think there's one real solution. I think profitability will be sorted. I have no doubt about it. The only thing that we have done, but maybe that's because we had one extra, like really tough external event that hit us, is that we want a proper cash business next to our PayGo operation. So we really think, so maybe not for the sector, that to become a little bit less vulnerable to these type of things, it really helps that you have at least one part of your business that generate cash fast. So those are the things that at least we did.
Yeah.
But you look like you know a lot as well about it.
I can build on that, but see how we come out strong out of the COVID period. I think we've been. I'm just looking back now at what happened, and I just remember we created a spreadsheet pretty fast when we saw this coming, hitting Europe and then coming through Africa, and we created one different kind of things to do, and two columns, one kind of slowdown scenario and one lockdown scenario. And we pretty much just worked up, what do we do when certain things happen, right? So I think as a business, as in kind of operation functions, we're here because we've been pretty good at evolving and building that business, and that also allowed us to be responsive and agile in that period. As a business coming out, we took a big hit from sales, from utilization, or collection rates. But we were, at least during the COVID period, we were able to fast, even move people doing call center collection calls, moving them from an office space where fibers are drawn in, and then all of a sudden move those 70, 80 people to work from home, where they're even struggled with power themselves, right? And then let alone getting them a decent internet line. So I think a lot of that is has I think as an institution and different memories in between us, that's obviously why we are where we are, I'd say. But yeah, from our side, and Azure, we haven't had that leg to stand on, I'd say, from larger systems or a different business line that could provide that foundation when things were shaking. And I think looking at the smaller systems, tier 1 or smaller systems, lighting units, we've seen those in particular struggle, particularly here in Kenya, at least from my point of view. So it's hard to see how we could, and it gets to then the kind of sustainability discussion. Well, how do we serve that segment if it's yet those hundreds of millions that need to be served? But that's, I guess, it's another discussion that we can go on and
Well,
the
it's
expert in
one
that.
of the biggest challenges, I think.
So I think that's that's a bit that's what's our experience, and that's what's our thinking. From our perspective, what we've done. I think from an efficiency, from an industry, Kenya is more, I'd say, more advanced, maybe more players here, and it's not that there is a fight for the market shares or get a slice of that, but obviously it's more crowded. We work through the same agents. It's an informal sector, and even the consumers, to a certain point, they could take advantage of using a system for a few weeks, for a couple of months, and then replace, move on to the next, and then what? It's not. Yes, we can see sales moving to someone else, but as an industry, it doesn't really help. But as I said, we are winding down our operations here to the extent that we've stopped doing PayGo for the normal solar home systems with Kenya, and then as we've always, from an Azure lens, with our beliefs has been in, let's not just build all the core competence ourselves, but rely on others who know their bits. So we'll work through partners, B2B to C, and I think where we're now facing this new era, we've decided to, and we're pleased to work with another PayGo company who's actually doing essentially collections and customer service for our customers. And it's, I'm getting the sign, can't hear me. But I think reflecting on it from a big picture perspective, this is something that could be scaled. Doesn't have to happen when we're at this level, when we're facing issues. So there are efficiencies, I think, that could be gained.
Yeah. So, in terms of, for instance, the pandemic, I think one of the challenges that we faced as a company was related more on the supply chain side because of all the lockdown that happened in China, and definitely. So we had a lot of stockouts like anybody else. But definitely on the Congo side, there wasn't much of the lockdown, but definitely
It was on paper.
it was more on paper, yeah, definitely. But in those cities that were seriously locked down, we struggled with. Yeah, there were struggles with customers and things like that. But definitely for us, it taught us, so we learned from that experience in terms of diversifying our product suppliers. So at least, and then we really strengthened our partnership with a second supplier. I think that is helping even now, because you never know where problems can happen. It might be pandemic today, it might be US-China trade wars and things like that can hit one supplier. And if you only depend on one, definitely becomes a challenge. But again, in terms of the future, in terms of as Arno said, the future is exciting. For instance, if you look when we started, we were dealing more even, if you look at product awareness, people, we're only used to very poor quality products, right? So you had to go there and really educate the people on these high quality solar products. I think we are not dealing with that. It's still there, but not at the level to where. So it means that there is already high awareness about high quality solar products, which becomes a little bit easier for people to reach customers and sell to them. But if we are also looking, we are also seeing customers now demanding even more and more larger systems, as Anne also said. And all of this creates opportunities for companies. And we believe these are things that we will focus on: productive use of energy products. All those are opportunities that this market presents. But again, when it comes, and again, I think it's also important because somehow, you know, in the sector, people starting a little bit forgetting about entry-level products and maybe focusing only on solar home system. The market is diverse. There are customers, huge, like millions of customers that can only afford entry-level solar, like entry-level products. We are talking about basic like solar kit that provide only lighting, a smartphone charging, right? And for us, we have really a range. In the DRC market, we have a range of products starting from those entry-level solar products to bigger ones, to even solar generators. And we have seen that has helped also a lot. Yeah. But important also is the issue of portfolio quality, especially when it comes to pay-as-you-go solar. Yeah, because early in the industry, it was more about how many you've sold, how many people you have reached, talking about these huge numbers. I think as we move forward, the focus should be like, definitely we need to reach more people, but more about how, like, the quality of the portfolio that we are building, because at the end of the day, we need to collect the money to be able to pay our debts and also to fund our operations and, bring in the products. So there are, investors, companies all have to play a big role in terms of how do we make sure that this portfolio quality gets really priority and people have, innovate around there. Even incentives on how to, on innovations that, improve portfolio management is very important.
Thanks for that. Yeah, I think I'd like to continue a bit on that note. We've heard that on average collection rates are around 60%, I think, in the sector, so that's too low. What do you do actually to achieve good, strong portfolio quality, and also ensuring that you're actually selling to the right customers, right?
I don't think there's an easy answer to that. We heard about data earlier in the day, and we're trying to be a bit more strategic in terms of how we sell products and how we evaluate customers in terms of viability. And before we offer a pay-as-you-go system, but the reality is we're not doing that. At the end of the day, your agent stands in front of a customer, and he wants to sell cash. The customer says, I can't afford it. And the agent is saying, just put this down payment and then pay this over a period of time. There's no scientific method right now in trying to profile the customer, at least for the people that are on ground looking at customers and trying to sell. And I think what we're trying to do is to improve that process, to make it quick, to make decision-making faster and in the hands of the agent so that they can do a profile of that customer and be able to assess if this customer is creditworthy. But if you imagine that, you're a field agent or a sales agent and your job is to talk to 50 customers every week and convert 10, 20%, that system needs to be really fast in deciding whether I should talk to this customer or not. But so there's that gap. And so what I think tied to what Arnold said is, for us, what we do is we put a lot of emphasis in making sure that our portfolio is made up of cash sales or near cash sales, and minimize the amount of monthly payments that we do. That's the way that we ensure that at least we are managing that portfolio quality. We also insist on a higher down payment. It's not scientific, but what it does is that if someone, a low-income person, has put a significant amount of money down, he or she would not want to miss out on the balance. And so there's an incentive to continue paying it off. So those are some of the things that we do. It's not scientific, but it also reduces the amount of portfolio we can build. And again, when you start looking at raising money, these are multiple KPIs that different investors are asking for. And sometimes it feels like there's a conflict, between trying to sell right and get a good quality portfolio and trying to hit your receivables to attract the right kind of debt investors. So it's difficult. There's no major answer to it. But I want to talk a little bit about the future and in terms of profitability. And we're not going to run away from it, right? So I'm going to break it down in very basic terms. Profitability is revenue or costs. And if you understand the problems around revenue and you understand the problems around costs, maybe there's a way to profitability. The goal is to make sure your costs are less than your revenue. So in terms of revenue generation, what are the issues? I want more cash sales. How do I sell to people that can't afford it? It means I need to diversify my portfolio and sell to people that can afford it. And if I'm going to sell to people that can afford it, I need to build products that they need, right? So one clear path is making sure that my product portfolio is diversified and it is selling to people that it's a combination of selling to people that can afford it so that my revenue is guaranteed and minimizing, right, the risk associated to people that can't afford it. And it's very difficult because the main reason we came into this space is to serve those people that can't afford it. And so it means that we need to constantly say, this business model, how can I tweak at it to make sure that I'm serving those people, but also still generating revenue? The key component of revenue is also the addressable market. We've heard the addressable market exists. So the problem is not the addressable market. The problem is, how do I sell to the right people and get paid for it? And so product and customer diversification is one key thing I see to anyone that wants to be profitable in this space, because we can't keep on selling to people at the bottom of the pyramid and hit profitability. It's one on the revenue side. The other thing I also want to say, I think we went to dinner yesterday and they used a Swahili word for slowly. I'm not sure what the word is yesterday. Pole, right? That's what it needs to be in terms of funding. Pole. You have to be, I know capital is patient, it needs to be a bit more patient, right? And I think Arnold spoke to it. So that we've demonstrated scale in X number of years does not mean that we can grow at 500% the next year. That's just the reality. If we're still focusing majorly on these people that we started this industry for, people that don't have access to power. And so it's important that, again, equity recognizes that it is taking a bit more time, yes, but to see, has there been progress that you can build on? Has there been progress that you feel comfortable that if we continue to invest in, it will take us there? Okay? That's the revenue side. The cost side, right? Where are my biggest costs? COGS. Most of my products are manufactured in Asia. So when there's a pandemic, I can't get my products. I have a stock out. How do I solve that problem of reducing my COGS? These are the elements, practical elements that are going to get me to profitability. Otherwise, we can all say wonderful things, but when rubber hits the road, this is what we face on a day-to-day basis that affects our ability to be profitable. Is it possible that we can aggregate some of the services that we all, as solar companies, go through? Because we face the same challenges of stocks. We face the same challenges of supply chain. So if, for example, that manufacture, that production is aggregated and is situated regionally where most of these companies are, it will reduce the time it takes for me to get my stock. And so the amount of times I can turn around each dollar is going to be more. Because right now, for every $100 that I invest, it takes me 6 to 8 months to just get the product. And then it takes me another 3 months to sell it, right? This is why we always need money, because I buy my products, I get money in bulk, I buy it, it takes me 6 to 8 months to sell it. And it's not at the end of 6 to 8 months I start looking for money. Otherwise, I have a stock out. So by month 2 or 3, I need to get more money to buy products so that I don't have a stock out. So I'm explaining the challenges from a cost side, from a revenue side. Whoever comes up with a creative and innovative solution is likely to get to profitability faster, right? But that is the reality, right? If my supply chain costs are coming down, if I'm able to get my products quicker, it will help me reduce my costs and get to profitability. Most of us are lean businesses. I joke and say, if I cut off any more fat, I'll be anorexic, right? That's how lean. I'm not sure of any of us sitting here, right, that is running a very, very bloated organization. We're pretty lean. Yes, there are some efficiencies that we need to work on, but even in terms of those efficiencies, we could benefit from economies of scale. Economies of scale not from an individual company perspective, but from an ecosystem perspective. Because if you solve my efficiency problem, you solve his efficiency problems.
But
right?
if you would leave the, we call it a small system, the tier 1 group, if we would park that for a moment, right? I don't see if you have a normal year, right? So no, even this year we have not had a single month without out of stock situation, but it was an okay year. As long as your collections are okay and you have a reasonable lean operation, there is no profitability issue, right? With discipline on your portfolio and collections, there is no real profitability.
You need to provide products to a higher customer a margin, a higher customer segment that you can charge a higher margin.
You can't leave the biggest group out to dry there, right? It's why most of us.
Yeah, I agree. I'm just saying that if sometimes we pursue these indicators, we lose the risk of forgetting the reason why why we're here in the first. So I'm all for that. And my point is just to show that if we want to meet those profitability targets and not lose focus on why we came into this industry, then we must change how we sell, what we sell, and who we sell to. Because the reality is those people, more likely than not, cannot afford those products on a cash or on a financing basis. And no matter the shock to the system, it takes them 12 to 18 months to recover. So we can either say we don't want to sell to them anymore, or we could say we're going to sell to them, but we need to find other ways to augment that gap and get to profitability. I think that's my thought.
And do you think you could maybe look at a model where you have like the high volume, super thin margin, like many retailers all over the world do, right? That would be the tier 1 thing. The only problem is now that even the thin margin is difficult to get, right? So the only thing we need to figure out is when the RBF times are over, because they will be over at some stage. I think it will be a long time still. But then at that stage, you're at such a massive scale as a sector, like nobody's going back to the candle anymore. And I think at that stage, so if those RBS, for example, could bring you to that stage, to that tipping point almost, right? Then I think you'll make a small margin on those let's say, high volume products. And it's other things that you really, well, I would say in terms of return on capital, even the small ones might be interested because they move much faster. So that the only thing I can think of that it could work.
I completely agree, but at the end of the day, if you're looking at your portfolio and you're being asked to deliver contribution margins of specific figures across all your products, then it's going to be difficult to achieve that. If you're able to take a loss leadership on some products and then augment and have a blended contribution margin, then it's possible to achieve, what you're saying. And the reason we're probably both going into so much detail to discuss this is so that, hopefully investors understand these are the reality and the dynamics of the products that we sell. And sometimes it may be difficult to achieve specific numbers across all products, and for all of us to be creative in terms of how we solve this problem.
Maybe just a comment there, so quickly on the consumers, to bring this to kind of consumer level, because in a way, this is all about the future of the industry, but it comes down to the individual customers that we've been bringing on board, and need to find the best cost efficient way of finding a customer onboarding, that kind of stuff, right? But I think, to your point, the utilization level being at a certain level. Obviously, TV versus solar home system different, and within that different segments, you have different numbers, right? But just as a data point, we did some analysis on individual customers, and we found this is kind of, I think it's good for everyone to know, probably you found as well, but what happened in the initial weeks, couple of months of a contract is a very good correlation to kind of probability of customers staying on or paying on time or will struggle. And we saw that customers who default or don't do the first payment in the first couple of weeks, as I said, there's 90 to 95% chance that customer will stay on being a poor customer. So obviously, if you put a small kit there, it does make sense to bring that stuff back. Can you afford it? Larger systems start to make sense, but I think it starts with finding that right customer. But then there are some operational metrics that you can look at, and data will help you to guide you in the right direction. But just as a data point, I'll cut you off there.
No problem. Very complex issues, but yeah, I think regardless of the product that you are selling, I don't think that there are products that are modeled to operate at a loss. And all these models gained a lot of popularity and buzz because I think they were said that they can be able to deliver these products to the base of the pyramid profitably. So somehow I think this issue of portfolio quality comes in there because it might take, definitely there are some years you can work at a loss, and then definitely you tend to, you target to achieve some profitability at a certain period. But if the portfolio quality isn't good, definitely becomes a little bit challenging to achieve that. But again, we have a combination of, People relied more on the technology and think that technology solves everything. We have understood that is not the case. It has to be combined technology and even community-based approaches for following up the portfolio. But again, if you look at, as I was saying about product quality, this customer is supposed to pay for 24 months, okay? And you put that every month will be paying $10 throughout 24 months. They are with a product that works maybe well for the first 10 months. And after that, the quality of that product goes really down. But that customer is still expected to pay the same $10. You don't go back to the customer and tell them, because now the product is not working somehow as it used to be. Now you'll be paying $3, okay, or $5. You don't do that. They are supposed to pay the same $10. So again, so that's why we are saying we have to look at product quality. So if you ask a customer to pay for 24 months, definitely the product also has to really deliver, throughout those 24 months well. So that it shouldn't be looking only at the customer, like somehow customer is not able to pay, but also looking why. Things like that.
Two-way street, right?
Yeah.
I mean, would you pay if the thing is not working?
No, no.
If you have a...
You can't, yeah.
Right, so and I do think over the whole spectrum, the biggest asset that all of us have here with this company is our customer base. The bigger and more variety, the better. And it will only have value if you have been treating them well, right? But if you do that, I have no doubt that profitability is not an issue, and also not scaling up, right? So yeah, I'm not that worried. It's more the the shocks to the system, as they tend to be called, they can they can bring you into trouble, and then you rely on people around you, investors mainly, that don't immediately start pissing in there, you know, right? That they take you through it, that you go through it together, because it's really not our fault, right?
This leads me to my final question. I think you mentioned it already, that all of you have an extremely large asset, right, which is your customer base. And what are some of the products that you think will be, you can leverage your technology, your customer base to sell? What do you see what role do you see, for example, for productive use, or for other consumer finance, for other consumer products?
I think one of our biggest assets is not just the customer base, but our distribution network, especially for people that have a direct sales force in the countries in which they operate within. I think that's one of the biggest assets, because what it means is you have a sales force that you have trained on how to acquire a customer, on how to treat the customer, on how to provide after-sales service. And those are key components. What may differ would be the product itself. So you're teaching them how to sell this particular product, how to onboard a customer for this particular product. So I think that's an asset that we have. And what it means is that we can pass other products or services through that channel that, one, either complement the products that we're currently selling, or they are the needs of the customers that we're currently serving. And I think that is something that is important to explore, because you already have invested in this network. You maximize the returns you can get from that network, is what it would be my view. But again, if I go back to the basics of revenue and costs, what am I trying to do? I'm trying to minimize, make sure that every dollar I have goes a longer way than it does. So it affects even the products that I decide to buy. It affects where I buy those products. So if I want to pass more products through my channel, I don't want to import them from China. I don't want to be at the mercy of supply chain. And I'll be saying to myself, what kind of things can I pass through my channel that I can have access to locally, right? Because that means my dollar will be spun around multiple times faster than if I imported it myself. And then I also want to say to myself, you know, what does the customer need, and what would be complementary to their livelihoods, would increase their ability to earn more money. What we have found is for products where customers can use that to earn more money for themselves or their family, they pay more. They pay consistently in terms of a pay-as-you-go or a financing plan. So if, for example, you're using a product to earn $100 every month versus you're using a lighting product in your house and you don't have money, you would pay for that product that you're using to earn $100 every month versus saying you're going to have light in your house. So those would be my considerations in terms of trying to utilize the investment that we have.
Okay. I saw Henrik and Vashikala, both of you nodding vigorously. So do you want to add to what your...
No, I think it's all I agree on everything on that. And I think, you know, just bringing back, you know, how this all started. I remember back in the days in Tanzania, we thought, you know, people would come to us and as we hold, you know, a glass of water far from you know, fresh drinking water. And I think that was true back in the days. These days, not so easy any longer, right? And I think that low-hanging fruit, that's now gone. We need to go deeper, find those customers, to find them and then sell and serve. It's more expensive. But for those customers, the future has started. You know, the life has changed. So I think let's not forget that. It's although we had it, you know, as a, you know, theoretical, you know, idealistic way of let's bring them aboard and then, you know, work with them to improve the lifestyle and you know, at least in our case, we've been able to serve them, you know, upgrading them, and that's what we've been doing, getting on to the next, you know, being a TV or being satellite TV and that kind of stuff. But even beyond what we do now, it's obviously productive usage and the bigger systems, potentially what you're proving, which is great. But as an industry, we're also enabling the next generation. We heard about e-mobility. There's a lot of learnings and things, although it's a very different challenge, but lots of things that we can learn from each other, and looking into the smartphone system, how that's been brought on, right?
Do you know of examples of, let's say, small cash items through the same channel that have worked? So we tried a whole bunch.
I think it's hard to believe that you can just channel any product through our last mile distribution network. I think that, at least in our case, hasn't worked because it's highly these, as I said, all the value chain. What we really rely on are these commissioned agents, who we have a certain relationship, but if they don't like it, even they tell us they're loyal, they're not, right? And if you ask them to go and sell, I don't know, any other consumable product, it might work, but in our case, we can't leverage that.
So for our case, smartphones are working. We've also looked at clean cooking solutions as well.
Cash, those old
Cash.
Like
So our portfolio is made up of products that are strictly cash, as well as products that we sell on a financing basis. So a key driver for products that we have fans, for example, we sell only on a cash basis. We don't sell them on a pay-as-you-go basis. We have clean cooking stoves that we sell on a cash basis. We don't sell on a pay-as-you-go basis because we can't put the technology on it. So I think the key thing is to continue trying. Some will work, some will not work. In some markets it will work, in some markets it will work. But I think just that consciousness of just saying it's not business as usual, and we need to be constantly listening to what our field agents are telling us and just testing it, to see. We've had things, we've tested them, they didn't work. So we didn't scale, right? But I think that for us is just what we need to keep on doing to just make sure that our agents constantly have a pool of products that they can earn good money from.
So
I've been told that time is up, so I would like to open it to the audience so that we can at least take 3-4 questions from the audience as well. Yeah.
Hi, thank you so much. Really fascinating discussion on business model innovation, and thank you for sharing your insights. I just had a couple of questions around how long your products last for and what happens to them at the end of their life, and whether you've thought about bringing circular economy principles into your business models to help increase resilience of your supply chains and reduce costs.
We started with an assembly plant to recycle batteries, because it's coming our way, whether you like it or not. So either you join up with somebody else, or you do something yourself. But I think it's one of the biggest, let's say, non-financial thing that is coming our way. All those batteries, and then so the actual assembly and the manual work is not easy, but it's doable. But getting those batteries where you need them, that's going to be more of a challenge, but solvable, I think. But yeah, you're absolutely right. I think all of us, we need to start now. You'll need a year to get it right, at least.
Oh, okay. I think my question will be directed more to Seke. So very, very interesting discussion, and I've been listening very keenly. And I think I really like to understand how you are thinking around backward integration. And I say that because I do know a lot of the large corporates like Nestle, etc., and how they have been able to target and be profitable on products, that serve the bottom of the pyramid, have been really around backward integration, etc. And I know this, bearing in mind that, basically they started with this type of model and then basically innovated. So how are you really thinking about that? What are the challenges you think you would face? Just generally, yeah. Thank you.
I think that's a great question. And I'll answer it from the perspective of aggregating business enablers, right? Unfortunately, when you raise money, you tell your investors what you're going to do, and in that, In that plan, we didn't tell them we're going to do backward integration, right? But is there value? Yes, there's value in it. And I think that in itself, what it does is it provides an opportunity for anyone that wants to come into the space. So in Nigeria, for example, I know that a lot of impact funds have been funding people that want to do some level of backward integration. So we have a couple of solar panel manufacturing companies now set up. My biggest cost component in an SHS system is the battery. We don't own the IP to that technology. So there are a lot of things that we need to do before we get to backward integration. And I think enabling that ecosystem and saying, what do we need to build in a way that that ecosystem exists and is closer to where customers use this product is critical. So we could be looking at, backward integration for panels, for batteries, and any key components, devices, and accessories. That opportunity exists, and I think the way we have handled it is to just try to partner with people that can provide some level of aggregation services. That's how we've done. But in terms of us as a business, that's not our focus. But is there value in it? Yes. And I think that in itself is an opportunity for anyone that wants to come into the space.
Yeah, thanks. Two questions from me. One is maybe the future of the market, especially in an instance where a lot of the original PayGo companies are sort of moving away from this segment. How do we retain the institutional memory for new players that are coming in? I guess it's also happening obviously also in some segments of the mini grid market where, some of the mini grid players are moving into CNI. So how do we sort of straddle that sort of maturity of companies and retaining the institutional memory into the market? The second bit is, I think, borrowing from Eva's statistics from the Gogla data, and also some of the discussions you've touched on. I think you've said obviously we all know the affordability issue never goes away for some significant portion of the off-grid market. We've seen the success, or at least the strides made in the supply side subsidy, around RBFs. I'm curious to know how you how do we angle potentially end user subsidies around the less, the hard to reach, the less affordable segments of the market, considering also I think you've said there's an element of some products potentially could be loss leading or very low margin. But again, you sort of have a challenge of most of your fixed cost base, your OPEX, you're still paying market rates, right? So how do you sort of angle that also in a situation where there's a mismatch of debt and equity in the funding game? Yeah, thank you.
So I think, how do we retain knowledge and sharing experience? My personal experience has been, I find it less competitive and, trying to, keep things within, your own house these days. Back in the days was much more of, this is how we're going to do it, we're not going to share, we're going to win the world, and therefore, to help with you, right? But I think these days it's much more of, okay, this is where we're at, what can we learn from each other? And I think, an example is today and Persistent's way of opening up and sharing experiences is I think the way forward. So I think that's where we're on the right track. Gogla as an institution is important there as well. Maybe someone else chime in on a second question.
So what I would say is, if I look at the future, I think it will be a disservice to completely ignore the bottom of the pyramid because that need is still there. If you look at the population of most countries, 50% of them are poor, right? On average, 30 to 50%. In developing countries, I mean. And that means that they are lacking certain things to be able to come out of whatever situation and to be economically empowered. So there will always be a need for us to focus on that. How we do it is the issue. in terms of your question related to debt and equity, if I had the answer, I'm sure we wouldn't be here, right? But I think it's important to always remember that, and in terms of looking at product pricing, in terms of expectations from developers, to recognize that, or allow them or give them the leeway room to be able to practice loss leadership strategies or very low margin strategies to be able to ensure that we continue to serve those customers. I mean, listening to the presentations that were on earlier on in the day, it just got me thinking that, you know, some of the challenges that e-mobility are having or will have are similar to the challenges that the solar sector had, will, you know, and have gone through. And, you know, one, they can learn from that, so that keeps, you know, us, you know, the memory of us alive. But more importantly, the last mile is always going to be an issue. And what do most solar companies do? They deal with that last mile issue. And I think a time is going to come where the same way you see the IOCs are consolidating and saying they're energy companies, right? We're going to have a subset of companies that are consolidating to be renewable energy companies providing multiple services. E-mobility will be one of them. Solar home systems could be one of them. And whatever other innovation may come up, right? But what that means is that if I decide to go to Tanzania, for example, right? And Nico has evolved into a conglomerate. His business is now a conglomerate, right? And he has multiple, you know, businesses. I don't need to invest the OPEX in terms of getting talented people to set up my business there. That could be one subsidiary of his business, right? And so I think at some point in time, we're going to evolve to a point where you're having companies that are providing multiple renewable energy services to the same customers, because what it takes for me to sell to the last mile, it faces exactly the same challenge. So why employ multiple people in the same country, in the same region, doing exactly the same thing? Either you consolidate or you aggregate. And so for me, I think that is one way that we're going to enjoy efficiency and get to be able to minimize our costs. Thank you.
Nico, I've seen your hand up for some time as well, so I'll invite you to have the last question and then also a maximum 1 minute answer to the last question.
I think this one is dead, but yeah, let me try to speak up. First of all, I fully agree with what you said, like 100%. And following your point on what you said, where, you know, e-mobility companies are most likely, if they're not already like experiencing the challenges that you've faced, we're most likely going to face these challenges. So having said that, all of you guys were talking about supply chain constraints, right? And we all know that with the new government, well, the old/new government in China, you know, most likely going to following up on the COVID zero policy, we can expect further supply chain constraints. So we are moving from, you know, just in time to just in time plus just in case situations. Well, I mean, it really has become a term, right? How are you guys coping with that? Because I mean, I heard you want to develop your own assembly line for recycling batteries. This would take time, right? Loseke, you said, like, how can you know, flip the product faster and be more independent? So what are your solutions? Do you already have solutions, or are you still looking into that? Because e-mobility companies, we're definitely going to be facing the same. It's a fact.
No, I don't have that for now. So definitely, we'll have, as I said earlier on, we had the same problems during the pandemic, but definitely we think it will continue. But for us, as I said again, we are working with different now suppliers. That we think helps. Some supplier might get hit with some lockdown in some areas, while others will be able to operate in other areas. But definitely, we are building a very huge, large storage capacity in country. And what we are doing now is really to order for 6 months. Because, you know, what we have learned definitely, bringing in containers every month, definitely somehow they got caught in that and you are paralyzed and you have a lot, like long stock outs. So definitely what you are doing, you are building a huge infrastructure in country in the DRC in terms of storage capacity so that we bring for 6 months and even over, and have that in the DRC and then focus on the distribution. These are some of the things that you are doing. I think, it can also help with immobility, but maybe you are assembling in Dar es Salaam, I don't know.
Yes.
Okay, yeah. Yeah. Yeah, definitely, I agree.
So it's a risk, and I'm not sure that we have the answer, the solution to all the problems. You can only plan, and you can try and mitigate that risk. And for us as SHS companies, one of the ways we do that, again, is like he said, order ahead, but that means you're tying down your capital, right? So that means you need to try and renegotiate with your suppliers to get credit lines that cover 3 to 6 months before you pay. So that helps in terms of funding and cash flow. So that if you can, not all suppliers are going to be flexible to give you longer payment terms. But that's one way that we're trying to make sure we always have stock and we don't run out. The second one is the distribution network. I don't know who has operated in Nigeria. If you think your distribution network is complex, come to Nigeria. It is mind-boggling. And so even when we get our distribution network right on a group level, when you get into the country, it's just amazing. And so trying to sort that out, that distribution network that has a combination of warehouses, stock points, and things, to make sure stock is in the right place at the right time, where it needs to be, is the second thing that we're doing to try and solve that problem. And ultimately, we need to build that ecosystem that is closer to where the customer is. So it doesn't have to be in each country, but it can be regional. So that, again, it minimizes supply chain issues that you have and can get products to you faster.
Thanks very much. On that note, I would like to thank all of the panelists, and I would invite you to continue these discussions later on. We'll have time in the evening, and I think there's a lot of experience in the that can be shared between all the participants of the conference, and so looking forward to hearing what's coming out of these discussions. And I'd like to hand over to Varimu, who will introduce the next topic to us.
Thank you very much. Let's give another round for Eva and her panel. Clearly, there's strong interest in the off-grid sector. So we are going to have a small break so that people can stretch their legs. Let's go for some tea, coffee, and come back at 4:15, 10 to 15 minutes, please, so that we can have our final session, the CNI panel, before we go for our evening reception. So it's where you were before, after the reception, down on your right, and then let's be back in about 10 to 15 minutes so that we can carry on with the next session. Thank you. team, the audience is quite spread out. So if you can just move into the 3 rows. So the audience or the delegates on the last row, let's move into the front rows just so that they are able to record better and you're able to participate better as well. Your bags are safe, so just please move in from the last rows and the last sections. So the last sections at the very end on my left, please move into there are seats here that are empty. Yes. And then on my right, the last sections, please move into the seats that are empty on this side. So, Peter, Leah, let's move into these seats here. Dennis, let's not be shy. There's more space on this side.
Come on, Dennis, here. Dennis, here. Is this 2 center?
This is great. That's perfect. Cindy? Yeah? Let me just get a confirmation. We're looking good? Thank you. All right. Asanteni sana. So we are going to start the next session, which is a very riveting discussion on CNI solar. You've had your coffees. We've also had our coffees, and we are ready for a great discussion. So we've got our panelists. I'll first introduce them and then introduce the session and why Persistent is excited about CNI solar. You already know me. I won't do that again. But on my left, Nekesa Simiyu, Senior Investment Associate at TripleJump, who also works on the Energy Entrepreneurs Growth Fund, and she and EGF have invested in several CNI companies, and she's going to speak a little bit more about that. And previously from Open Capital, she is Kenyan, based in Nairobi. And next to her is Philippe Flamand, who is Commercial Director at Kandi, a CNI solar company that we have invested in and are involved in at the board level, based with operations in South Africa and India. We also have a prince on our panel, Prince Ojiabulu, who is CEO of Rensos Energy, a renewable energy and CNI company with operations in Nigeria and West Africa. So, why are we excited about CNI solar? There's a report that I would encourage you all to read if you haven't, which is the AFCIA Annual Outlook for 2022, which reported that there was increased installed capacity in CNI solar, 20% in 2021 than it was in last year. And why is that? Because there has been increased load shedding, there has been increased cost of grid electricity, especially for industrial and commercial premises, and CNI solar continues to have that promise of really being part of the leapfrog of industrial Africa. And we, as Persistent, are very excited about CNI solar because it drives sustainable development. As you know, a lot of the grid-connected energy or electricity in Africa also comes from what we call dirty sources, which is not renewable sources. And CNI is clean energy, it is solar. And it also, one of the losses that occurs for most industrial companies is because they have to suffer from load shedding. Those in Kenya, those in Nigeria, various African countries, even though our national utilities have worked very hard to increase energy supply, there is still that issue of power cuts, especially, say, during the dry season when there are not enough rains to cater for hydropower, which is a huge source of power in most countries. Another reason is because CNI is more reasonably priced and cheaper than grid electricity. According to another report by, I think, Energy for Growth, companies save 15 to 35% of their electricity costs by using CNI solar instead of grid energy. And so it has that direct climate positive impact, as I mentioned. So we're going to be discussing more about what these companies have been doing, Kandi in South Africa, Rensos in Nigeria, and what investors have been thinking about for the past, the present, and future. So the investors are represented by EEGF, by Nekesa. So in our panel discussion, we're going to be looking at the past, what are the challenges, the present, the future, and what we can all do as a sector to encourage the uptake and the profitability of CNI solar in Africa. As we start off, I'm going to invite Nekesa to, Philippe to gosh, I've had enough coffee. Rensos Energy. So please, Prince, introduce Rensos Energy to us.
Okay. Okay, I can hear myself. Good evening, everyone. I'm trying not to bore you out. I know this is the last session, so we want to try to give you as much energy as possible. But it's an interesting topic, and I will just introduce Rensos as quickly as possible. So Rensos is, I think we like to see ourselves as financing, developing, and then building solar solutions, okay, across Africa, mostly in the CNI space. We look at different solutions, diesel hybrid, diesel battery solutions, natural gas, etc. And of course, if you see, and I will just clarify a couple of things, but if you see, you see some of the metrics there, but, and you see 12 micro utilities contracted across Nigeria. And that's because a few years ago, our focus was really around micro utilities, which is a sexy name for mini grids for urban areas, okay? And we've recently started looking very closely at the CNI sector and have been working there for the past 2 years, really accelerated by the COVID-19 pandemic, which of course other speakers have spoken to. So I'm sure I would still have some time during the course of the conversation to throw more light to all this, to this summary. Thank you very much.
Thank you, Prince. And now, Kandi, Philippe.
Good afternoon. Kandi is effectively an elongated acronym of CNI. So this is very much a topic that is in our DNA from day one. Kandi is a provider of solar to commercial and industrial users. We oversee the installation, we finance, and then we operate the asset for the customer. Two of the biggest barriers to going solar for businesses are obviously the upfront capital cost and the technology risk. And so when we finance these customers through a power purchase agreement where they pay per kilowatt hour or some other similar structure, we're essentially removing those two barriers. We operate in India and South Africa as of today. We have 71 installations, 40 megawatts contracted, and now actually almost 30,000 tons of CO2 mitigated. And I'll stop there.
Wow, thank you, And last but not least, Nekesa, tell us a little bit more about what you do.
Yeah, thanks very much. Hi, everyone. Thanks for still being here and still willing to listen, even in the last session. My name is Nekesa Simiyu. I'm here representing Triple Jump. So Triple Jump are an investor in the impact space. The bulk of the work that Triple Jump has done, like a lot of the mandates, have mostly been in the MFI and fund investment space. But since 2019, we also raised our off-grid renewable energy fund. And then since then, we've also closed another mandate. So as you can see on the slide, currently within the off-grid renewable energy space, we have 2 mandates. So EEGF, which some of you may know. So this closed in 2019 with the 2 anchor investors, that is Shell Foundation and FMO, at a first close of around 45 million. And since then, we've managed to get commitments from 3 additional DFIs, that is FinDev, NDF and DFC, bringing us to slightly over the 100 mark, which was quite a milestone for us. So we're currently at 106 million, and we hope to get to a target of 120. So I guess EEGF is maybe relevant in this forum because we invest across, I guess, the whole range of off-grid companies. So think about solar home system companies, CNI, mini grids, productive use, as well as enablers. Currently, we have 7 portfolio companies, which include 5 solar home system companies and 2 CNI companies. Maybe also, I guess, worth mentioning also on this slide is, I guess, as part of our facility, we were also able to get the AFDB COVID relief program, which we are currently blending in also with some of our facilities and hopefully trying to provide a bit of, like, I guess, reduced rates to our investees. But other than EEGF, which I guess I'll be mostly focusing on when I'm giving the perspective on CNI, we also were able to close the mandate called CEI Africa, so which we are also working with on Persistent. So perhaps what I should have mentioned is on EEGF, we are working with Persistent as our advisors to the fund. So we work quite closely with them on the deals, given they've actually been in the space for the last 10 or so years, with quite a lot of insights also on how the sector has grown where it is right now. So we collaborate quite a bit on that. And then on the CEI mandate, this is a KfW mandate. It's mostly now looking to focus into how to catalyze investments in the mini-grid space. And on this mandate, we're working with Persistent and GreenMax Capital as well, where Persistent will be leading we're calling it has 2 windows. So Persistent will be leading what we call the crowd lending window, and GreenMax will be leading the results-based financing window. If you want more details on the mandates, you can come chat to me after, or actually chat to Persistent and GreenMax. But yeah, I think I'll stop there for now. Is there any other slide? Okay, so I think I've touched a bit on this. So as EEGF, ideally when the fund was being raised, where we saw we could be quite beneficial is, I guess, in this gap that is highlighted here. So not the very, very early stage and not the really mature business, but this businesses here which are kind of in like just leaving the early stage and getting into the growth phase, which still need quite a bit of risk-taking capital. And in that regard, we thought our sweet spot especially would be mezzanine, because at the time there was, yes, some equity in the sector, but the balance sheets are not also that strong for a lot of the companies in this space. So we thought we could fill that gap with some risk-taking capital and ideally bolster the balance sheet so that they can be able to raise a bit of senior debt. But granted, even saying that, we also still have some allocation in equity as well as senior debt. But not to belabor that point there, I think one thing that's also quite relevant, I guess, for EEGF is that we're collaborating with Persistent and also trying to work with our investees to provide them some form of technical assistance, as well as maybe engine room with Persistent's VB experience, then they can also go in and hone in a bit more on the finance functions and software, etc. But yeah, let me stop there. I think I gave quite a long introduction. People are tired.
Thank you, Nekesa, and thank you for also introducing the virtuous circle that we have as Persistent, Triple Jump, and our portfolio companies. So you spoke about that, but also worth mentioning that for both Rensos and Candy, we are investors and are also active on the boards of the companies. And so we've been able to participate in the strategic thought there and seen the industry grow. So let's reflect on the past, the lessons, the challenges. And I'll start with you, Philippe, because you have been in business for quite a long time in CNI. What would you say when you consider the various challenges or lessons learned, financing, technical capability, etc.? What are some of your learnings?
Sure, I mean, there's a lot. You know, I think I suppose there's all the usual things that come with starting a business. Raising capital is obviously always a challenge, particularly in the early days, the proof of concept. You know, later on, there's the sort of maturing as a company, the institutionalization of processes, the hiring and managing of large teams. There's the supply shocks that one has to deal with. As a company that is ultimately supplying hardware to a customer across the globe. But those are, I suppose, challenges that are not really unique to commercial and industrial solar. I think you know, any industry sitting in this room would probably highlight those as challenges. I think probably two things that I would say are perhaps not unique, but that I would emphasize in the context of CNI is, number one, the transaction size is something that is challenging. That seems a strange thing to say in a room full of people that are dealing with, you know, solar home systems and e-mobility, which are obviously far smaller. But the reality is the deal size for CNI Solar is larger, in that there's a material quantum of capital being deployed per transaction, but it's not so large that one can, you know, spend the type of time and resources and energy as one puts into a utility scale project. Whereas the complexity of that solar system may in fact be even more complicated than a 300 megawatt ground mount solar system, because you're dealing with rooftops and each one is different. On top of that, you're writing contracts, power purchase agreements that are 20 years. So you're essentially taking credit risk on a counterparty over a very long period of time. So a credit assessment needs to be done that's robust, but also needs to be efficient. And then on top of that, you need to manage that distributed portfolio of assets over a very long period of time to optimize your revenues. So I think those are the things, that's one of the key elements that is quite challenging and really makes companies in this space need to focus intensively on process optimization. I think the other big challenge, and that's perhaps been a surprise, coming into this space, is I think one of the things that's difficult in pitching commercial and industrial solar is really the client education. I think there is a huge demand for CNI. I mean, the cost of solar per kilowatt hour in the markets that we operate is 40, even 50% cheaper than the grid in many cases. So the value proposition is obvious, but there's a lot of noise in the space. There's a lot of confusion in the space. There's a difficulty, and I think Tim from Home touched on this, even in the home solar space. But it is a challenge, to communicate the value proposition clearly and create an apples to apples comparison. So customers get stagnated by sort of, the decision that they need to take. Also bearing in mind that for many of them, there's only one opportunity to put solar on their rooftop. So it's not something that you're buying month in and month out, and you can then decide you want to go with another supplier. So I think there's There is a psychology of the sale, which needs to be cracked a bit more in this space. And there's a lot of confusion, I think, amongst customers, which has diminished the potential acceleration that could happen in this space.
All right, thank you very much, Philippe. And coming to you, Prince, you're really transitioning. Would it be the same kind of challenges that you've seen? Or are there some that maybe are special for the Nigerian market?
Yeah, thank you, Arino. So yes, I think just a few things, relatively right, they're almost the same thing, basically, and we've had internal conversations enough to like compare notes and say, see, even if we're in different geographies, right, it's almost the same thing. You see customer education quite low, sales process is quite long, internal processes need to be very top-notch to manage the risk associated with it. Capital is a problem. You need to make sure you have capital if you're going to do the business. However, I think we are transitioning. I think what we have seen, especially in the Nigerian market, is that given that, the value proposition is quite clear. There's a huge energy deficit. There are C&I off-takers, but the process of getting the solution or the product over to them, it can be a very, very long process. So I think the fair amount of work is really, and which is a challenge, is really how do you shorten that process and make sure that you still have your eye on the risk and you're not losing the risk around it. And I think of a few things really around how we have been looking at it. One way has been, we have been internally trying to segment customers and say, okay, what exactly is a unique value proposition for this set of customers? And I think we dimensioned a bit really around sector, but also really around mandate. So you speak to some customers, especially large corporates, and they say, see, what is really interesting for us is that we think this will help us reduce our carbon footprint. We want to do this. You talk to some other customers, they say, are you really even sure this will work? Especially in the manufacturing side, they say, are you sure this will work with my machines? And you have to spend a lot of time trying to explain. And then when you do that, the sales process is extended and extended. And then the resultant effect is that you are having a very, very long cash cycle, which now, really brings the need for making sure that there's adequate capital, to manage through that whole process, et cetera, et cetera. I think really it's really around that, but also to maybe provide more context really around, the market. In the Nigerian context, I think the last panelist had alluded to that we have seen over the past few months a significant spike in diesel costs, which has really affected a lot of businesses. And then that has also accelerated the demand. So I think the fair amount of work in terms for us is to see how we basically streamline that process, keep our eye on the risk to make sure we're not losing that while trying to grow as quickly as possible, grab market size, market share, etc. And I think that's basically like the good part of the challenge. Yeah.
And I'm just curious about especially the customer education and why the sales process takes so long. Aside from the, having to educate them on the product. So for instance, let's say talk about Nigeria or South Africa, where it's almost, to me, if it's a big industrial customer, it's almost a given that they should adopt it. Number one, what are the timelines that you're seeing? You've talked about how you're shortening the timelines. So starting with you, Philippe, what are the timelines that you've seen, and what would you really pinpoint is the issue that needs to be especially addressed when it comes to customer education?
So I think, look, average timeline is probably 6 months from start to finish. It can be longer. Obviously, there's good cases as well. Look, I think at the end of the day, there's a couple of things. Number one, in a business, there's typically not one decision maker. It is typically, as I say, it's a one-time decision for them. So, you can't give them a sample, let them enjoy it for a month, and then, sell them another month, and then, so there's really a kind of binary nature to the sale. Which again just creates a slightly higher hurdle for the sell and for the decision to be taken. The other thing is, at the end of the day, and this is a little bit different when you get into obviously the storage plus solar play, but in many cases, whether they wake up and make a decision or not, electricity continues to flow into their factory. So I think the tangibility of the value proposition is often hard to hit home for them, because number one, it's not a core business decision. It's a cost-saving decision. It can be deferred to tomorrow. Neither is it a particularly sexy product. You're not buying a new vehicle which you can park outside in your parking lot. You don't see anything. Quite frankly, you're just talking for months. There's just paperwork. So what's quite interesting is that we've found that as soon as a solar module arrives at the factory or the farm or whatever it is, the psychology shifts almost immediately. Suddenly there's something real, and it kind of decompresses the whole situation. So we are playing with that psychology now and trying to come up with innovative ways to kind of give that sense of tangibility up front. But I think those are the elements that conspire to make it just a more difficult sell, and I guess it's hard to kind of push for a decision quickly.
Prince, would you agree?
Yeah, I will, totally agree. And, Philip stealing the words from my mouth, but I would provide a bit more context to, further to, what he has said. And I think a couple of things are, when you speak to, some of these customers, and I think going back, right, a path to scale, which we'll talk about very much maybe later, would be really as much as it proliferates, right, and you are building similar solutions for businesses that are alike, the adoption, I think, will grow. And I'd give a very, very quick example about, a typical manufacturing company that we have tried to sell to, and they certainly would be like, okay, have you really built this for manufacturing companies before? And feedback is, oh yeah, we have, or we haven't. And then but we have built this for agro-business, and they say no. Agro-business is different. What we do is different, but it's a bit of work to start, and then there is really little to nothing to point to say this is how it is. So I think that part is something that will help, and I think in my experience this is something we've seen while we try to sell. And then just to add a bit of context in terms of timeline, what Philip has said around the timing being 6 months is actually real. In my experience, I've seen shorter timelines, like 3 months, but averagely you see 6 months, even going to 12 months. And this is because really you're selling, B2B sales is really different from B2C. You're working with multiple stakeholders. Maybe you have the finance director who's going to look through stuff of your potential customer. You have the CEO, you have the board. Unique to every business, what their process is in, making a decision around whether they're going to adopt it or not. And basically, I think another very huge factor is that being that it's a PPA model, right? You're basically selling a product through contract, and these contracts can be the smallest I've seen is about maybe 30 pages of contract that you need to have your customer to look through, read through,
And normally, as soon as you bring a contract out to a customer, they're like, whoa, okay. I know this is going to help me, but okay, let's take a break. Let's look through this contract. I really don't want to tie myself down, etc. But the few people we've worked with, beyond that, you see that the value proposition is clear. You see that the advantages is clear. I've worked with a poultry farm, one of our biggest installation, where the chairman of the farm will say, see, we're seeing 40% savings month on month. And this is something that you would expect that, the adoption can grow, that it would grow, like wildfire, but it takes time. So I think we as C&I developers are looking through more innovative solutions to see how we're able to sell quickly. How do you standardize contracts? How do you profile customers and then know what type of contracts? How do you look through the process? Even I've had ideas just listening to Beam around how we could already profile people beforehand, and then that shortens the timeline. So there are there's a lot more to do, but we really need to think through it, and then we are doing that. And then whilst you're doing that, you need to still keep the lights on. You need to manage the business. You need to look through the processes, etc. It's quite a tough job, but it's rewarding when you make a sale, when you do one. It does make sense. I mean, in terms of quantum, it's quite large, and I think that's the joy.
All right, thank you, Prince. And Nekesa, coming to you. You've invested in, I believe, 2 C&I companies and other off-grid companies, including Kandi. What do you see working, and in your due diligence, what would you like to work more, either as problems solved or as new areas or new technology even as we look to the future?
Yeah, okay. Thanks for the question. I think given also when we raised our fund, I think EEGF is at a very interesting time in this sector, where there's businesses which have already been operating for a couple of years, which are seeing even like more than 10 megawatt peak installed. And then we have the ones which are also much smaller, like the less than 5 megawatt peak, etc. I think from just an investor's perspective, of course, when we go in and we're looking at a business, of course, we want to make sure the business model works. Like fundamentally, the unit economics are in place for the business to scale. And we also want to see at least some form of traction. Because I think one of the key things also for the C&I sector, and everyone says, is like there's all this demand growth drivers. And the sector is also estimated to be in the hundreds of gigawatts in terms of potential market. But I think all the challenges they were also just describing about, they can also be translated to investor challenges, because at the end of the day, we want to see businesses growing and then growing sustainably and efficiently. So the question is then, how do they also capture that market? I think you've talked about how sales lead times used to be quite long. I think we're also seeing those reducing over time. And I think that's also a function of, I guess, awareness, and the initial players also going in and kind of doing the hard work. And then now you also have testimonials to be like, okay, this is how it works for the different subsectors. But yeah, I think we are at an interesting place in the sector. The concept, I guess, has already been proven. So I think it's just about, as investors also just decide, figuring out what tailored financing works for the different types of the businesses, because we have the much larger ones, we have much earlier stages, of course, companies which require that very patient capital and a lot of equity. I think that's mostly what I can say, I guess, about the space.
All right. Thank you very much, Nekesa. And again, on the theme of looking to the future, speaking to you again, Philippe and Prince, in terms of especially regulation, right? When it comes to renewable energy, when it comes to C&I solar, what can governments do, especially in the countries that you're operating in, or perhaps even have done, to encourage, more uptake and a more attractive case for businesses like yours to operate?
So I'm sure a lot of my challenges will be Philip's too as well, but I'll speak to some unique, especially around regulatory stuff, and really not to take away from the government and the regulators and what they are doing to help the space, given, the unique challenges they face around implementation. And I'll give a very, very good example. For renewable products in Nigeria, for instance, there are no import duties. That's on paper. Yeah, that's on paper. The reality is you will pay those duties, whether you like it or not. Now, have we moved, in terms of regulation? Yes, we have, because the first step is actually really to try to modify the regulations to meet what the industry is doing at the time, what the economy is, etc. And the next step is really implementation. I've really, even as recent as today, had to pay duties for some of renewable products we're trying to import. It's that recent, and sometimes you can be dazed by that. However, I think some other challenges really is, which are quite light, is really, I think, and might not go away, but I think I would right now mention the challenges and then try to think of solutions that are you could repeat, if I use that word. So government bureaucracy is a thing. I'm not sure so much around the more advanced climes, how that works, but in Africa, regulation can take some time. For instance, if you're going to do a deployment that's beyond a megawatt, and we are in the process of doing one as we speak, you would need to get a captive generation license. And it takes a lot of time to get that done. It could take about 6 months to a year to go through the documentations, the processes. And in terms of solution, how I think that has been really addressed a lot more in the mini-grid space with facilitators like the REA, Rural Electrification Agency, who have really taken that central spot in terms of regulation to work with every other regulatory arm, trying to facilitate and making sure that, bureaucracies are broken down to, so these things can go faster. However, in the C&I space, it's quite nascent. Regulation still has there's still a lot of gap that needs to be filled from a regulatory perspective. And I think if those kind of things are put in place, I think it will be a lot better, and then you would see a lot of the private sector more interested in doing this, because it's a faster part. There's little to no regulation. And also, I wouldn't finish without saying, I'm not advocating for taking the regulations off. That's not, it doesn't really help any economy. It doesn't really help any business. There should be regulation. I think what needs to just happen is to make sure that the implementation of the regulation is top-notch, and then, the bureaucracies are knocked off, and then, when the private sector, businesses, et cetera, can see that government is taking, they're spending a lot of their effort to make sure that businesses can do business properly, then there's a lot of confidence from businesses and then consequently investors.
Yeah, I would just echo, I guess, what Prince is saying in terms of speed, because I think a lot of the regulation we see, and of course it varies from country to country, is not bad. But it's the speed at which, for example, approvals are able to be given that really just creates a gap, as you say, of 6 to 12 months before when you want to, start building and when you can. So I think speed is one big thing, and the other is honestly just clarity. I don't believe that the sector needs a huge amount of support financially. It stands on its own 2 feet economically. So in a sense, we as businesses can deal with whatever the rules are, but the rules mustn't change. So I think that's one of the challenges we faced in different markets. And I think one thing that governments need to get ahead of the curve on is really the regulation around what in different markets it's called different things, but wheeling or open access, but larger scale projects which use the grid to transport power directly to commercial, industrial, private users, because that really has the potential to extrapolate the sector at a pace that won't be seen if you can only do rooftop. So I think the regulation around that, even in a country like India, which is far more mature than anywhere in Africa with respect to CNI, that regulation is still not very well bedded down. So I would say that should be a focus.
Thank you. Nekesa, anything to add on what you've seen?
Yeah, sure. I think, I guess they've already touched on the various regulation aspects, at least the business is focused on, and at least as investors, we also look into that. But one key thing we cite in a lot of our appraisals is the risk that regulation can create conflicting policies. Because with a lot of CNI companies right now, they're mostly grid-tied, and that means they're also then taking a lot of the customers, or especially the large manufacturing and industrial consumers, they're taking them also from the national power producers. And we've seen in markets like, for example, in Kenya, as well as Ghana, where that has created also some form of either like uncertain situation in the market, because then if the policies will be conflicting, then that will affect adoption and scale up of the CNI companies. I think I can echo what he said, that the regulation just also needs to be clear, because from a company perspective and investor's perspective, it will be also good to just understand how does this look going forward, because any slight turbulent or conflicting policy could affect either our investments or like the opportunity for these companies to scale up. But yeah.
So maybe to also just chime in there and to say that I think in most of Africa, it's very clear that distributed energy is really the path to, energy independence. And it will be great for, government regulators to really start in advance, start thinking through, because in terms of the quantum in terms of the quantum and the amount that CNI addresses in terms of the deficit, right, is quite huge, right? And if the regulation is very clear as to some of the things, for instance, like what Philip talked about, being able to, feed into the grid, etc., it could catalyze and accelerate at a very, very fast pace. However, there's been limitations around that because of regulation. So I think a lot of governments around Africa need to really sit in and then see that it does make sense to know how to build the right regulations to support CNI businesses. It's quite new, yes, but in terms of, we've looked through the numbers and you can tell that the growth will be massive. I think about 30 to 40% over the next 10 years or thereabouts. So it's going to be massive and it's going to be more. So, that percentage could really increase by regulation, So it's just a food for thought and, word of note for, people in government, authorities, etc., to start thinking through that. And I'm sure, we'll do great things.
Much. And before we open the floor for questions, closing this off with the venture building focus, I turn to you, Philippe. Candy, Persistent was an investor in Candy and also a venture builder. We had two of our venture builders, Rodrigo Weiss and Fabio Rodrigo, venture building, and they then transitioned to Candy. Can you tell us a bit in 2 minutes about that experience and the involvement also at the board level and how you've seen that play out?
Sure. Yeah, I guess Persistent has been part of the Candy story before Candy was even a thing. So it's always been there. as as a support. I think it was mentioned. It was mentioned on a panel earlier today that when persistent people come in, sometimes you forget that they're persistent people, and I think this was no different case really. I suppose Rodrigo and Fabio were part of it, as I say, that Candy story from the get-go. They worked on helping me to build that business through the early stages, and I suppose at some point they just became part of the furniture, part of the DNA of Candy, and I think that's where Persistent takes a very sort of holistic view of what's going on in terms of ultimately, as Toby was saying earlier today, what is the value proposition here? What is going to actually create value for Persistent as an investor? Sometimes it's capital, sometimes it's the lending of resources, and I guess sometimes, it's a case where employees actually move over to the investee company. And I think that Persistent will probably agree that that's played out pretty well, because those additional resources have really helped Candy to sort of springboard to a position where we're in a great place in the CNI sector. So yeah, it's been, as I say, there from the start and continues to be actively involved with Toby on the board. So I guess much appreciate the involvement from day -1 really from Persistent, and I guess it's developed into a very cozy relationship, but one that's yielded, I think, very good results.
And with that, I will open the floor for any questions that we may have for our panelists. 2 to 3 questions max, so that we can also be able to proceed for the next proceedings. I have a question from Bim, Amos, and the third.
So just a
And Paul. All right.
Just a quick question from me. I mean, well done, guys. And I know you're managing a lot of risk, but you mentioned 20 years risk. Amongst all the many things you're trying to juggle, how do you build in FX into that, FX hedging, especially in Africa? At least I can't imagine places like Nigeria with that.
It's a story. Maybe if you want to have a story on his own.
Look, it's not an easy animal. I think obviously first and foremost you need to have investors that are comfortable and have the appetite for emerging market currency risk to some degree. There's obviously debt investors and there's equity investors, and we also treat those differently. I mean, in terms of the liability side of our capital base, we need to make sure that's protected from a currency perspective. So that's where we obviously actively engage in hedging instruments around senior debt in particular, so that we don't get sunk by the currency in terms of not being able to service our debt. From the equity perspective, it's much more of a long-term view. So trying to create a portfolio mix that not only has a fixed revenue stream, but has an inflation or floating interest rate component to it, so that, again, this is the kind of thing that won't necessarily work in the short term, but over the long run, and 20 years is obviously the long run, some component of purchasing power parity feeds through, and you get compensated, because obviously as the currencies depreciate, inflation spikes. I mean, that's exactly what's going on right now. When that happens, your revenues obviously go up. So it's about getting that mix of revenue streams right. I'm not going to pretend that we've perfectly cracked that, but we're very conscious of that. And it's absolutely something that one needs to be with that kind of tenor of revenue stream.
Okay. Thanks for that question, Bim. And really, there's an elephant in the room, so let me address that. Nigeria has one of the worst FX risk to actually ever take on. So that's a big problem.
But I think the first thing is really from an investor perspective, risk is really a matter of perspective, right? Are you in for the short term? Are you in for the long term? How do you see this going, etc.? Now, I mean, as new entrant, I think this was one of the first things that dazed me, like, okay, are we sure we know what we're doing? How do we dimension this risk? But I think a few things that we've worked around that we think it does make sense is a few things are really, number one, you look at the Nigerian market, a PPA model would mean that you will charge a tariff, right? And usually that tariff is really, what we try to do is index that tariff to the grid. Now, if you understand the dynamics, although it doesn't move as fast as it is, and I'll come to that, you know that the FX risk, macroeconomic factors, etc., affects the grid price. And in Nigeria, there's a methodology around that's called MITO. So basically, right, the utility companies manage their tariff based on that. So what we effectively do is, most of the time, we look for a very fluid tariff structure that is indexed somewhat to that, and that helps us manage change in FX. It's not as fast as, there's a lag, actually. But in the long term, if you look at it, there's pretty not so much in terms of difference. Another thing I think we look at is, usually we'd look at some very, very fixed escalation tariffs. So annually, biannually, etc., we're able to move those tariffs, okay, and based on the actual macroeconomic situation. So it's a difficult process to negotiate, but if you talk this over with a lot of business, and I've been on tables where we've negotiated PPAs in this type of scenario, and it's clear that, they're taking on this risk nonetheless. If you have to buy raw materials out of maybe import, you're going to spend FX. You're very sure that, you're not going to get all the FX if you're in Nigeria. You have to source from the black market, one way or the other. So, it's a risk that's already available to business. It's more, the work is really educating them to see that, hey, listen, you're taking this risk already. This is what we are also presenting to you, but in the format that you know that your cost is being reduced. It's not, I could say it here, it's not a very difficult, easy sell, but it's also very easy. Some customers, I think we've seen that we work purely on FX tariffs, and we've worked with we have a couple of projects that we're working on and we have worked on that are purely FX. Not every company, and we've understood that reality that if we're going to compete in the market, you can't go to Nigeria and say, you know what, my tariff will be in USD, so pay me. Like you would largely not sell, right? So you have to look at the fair blend of everything. And then from a capital perspective, you start also looking to what type of capital will fit that risk, okay? So it's a fair amount of everything, and it's a huge risk, but in the long term, I think where I see it, and this is my opinion, is that it will all normalize, and given that PPAs are really long term, 10 years, 15 years, 20 years, 25 years, in the long term, the expected returns are still what you're going to get. So I think that's pretty much it. And then again, there's a market. Nigeria is a market. People are doing business. There are issues, but you still have to do business, okay? And a lot of investors see that and know that this is temporary, we'll work through it, and then they see what type of innovative solution we're trying to bring to address that. And, well, I think it's kind of easy when you look at it that way.
Thank you very much. Amos?
Thanks very much, panelists. I just wanted to check what role batteries play in your solutions, and perhaps for the industrial sector solutions, whether the grid is still a critical component to those factories, or whether the solar solutions you're offering is actually adequate or perhaps sufficient. Thank you.
And I for 1 minute each for the answers.
Okay, I'll shoot. The short story is they are very important. So we operate in South Africa. Again, you saw what Tim presented earlier on load shedding. This is a massive hook for customers to come into the renewable energy ecosystem. So oftentimes it's batteries that starts the conversation, and then they understand that batteries and solar are self-reinforcing in terms of the value proposition. So increasingly, batteries is a core part of the pitch for us. But there are obviously different value drivers of a battery, from pure backup to arbitrage to other elements. So it's a bit more complicated, because with solar you just say, you pay us R1 instead of R1.50 per kilowatt hour, that's the pitch. With batteries, it's a bit more of a nuanced and less clear economic story. However, psychologically, going back to what I was saying earlier, it's a much sexier product to sell. So those two kind of counterbalance each other. But short story is it's a massive focus in South Africa for us.
I think I also take a go to say that I think it's also customer dependent, right? Typically, right, it's the value proposition for solar only, it's always better. It's cheaper than the grid, it's an easy sell. When you put battery into the mix, it becomes quite more expensive if you're going to put it on PPA model. And there are many ways where you think around how to innovate and try to solve that. One way I've seen is directly there are customers who say, you know what, we want this. And I do have a project now in Kano State in Nigeria where the customer said, see, I want to go off grid. Tell me your price. And there are a few people like that. They know that, and just for context here in Nigeria, there is grid, but manufacturers know that you can never rely on the grid, and for several reasons. One, because if you do rely on the grid, it's unstable, you will lose a lot of money in your production process. I mean, there's some production process that if you stop because of grid, you've basically lost your raw material, that kind of thing. So a lot of the manufacturing companies are actually off grid with diesel generators. Yeah, they do have the grid. Maybe they're supplying their administrative office, etc. But the actual core production, off grid. So, and when you look at the tariff structure, diesel versus battery and solar, you can still compete, right? You can compete very well. So again, there's a nuance around it, but how I like to think about it, and this is how we try to implement is, we don't upfront say, you know what, take the battery solution, except maybe it's a very urgent need on your side. We always want to say, let's go through the normal method, because putting a battery solution is like saying, we are doubling the capex for which you're going to use to do the installation, right? So we say, you know what, let's do this for 2 years, okay? Let's sit down, understand your production, your cycles, etc., and then build something we know will work, okay? Rather than going and then taking the upfront capex and throwing it there, it would be a worthy investment at the end of the day, because you would have to pay the way we'll structure it, but we think it's more beneficial that you do the right thing. So, I mean, there are many ways around it, but this is how we typically deal with it.
Nekesa, from an investor's perspective, how much relevance do you place there?
So first of all, I agree with everything they said. So as I mentioned, actually, so most options are currently grid-tied. And with the analysis of the potential markets across sub-Saharan Africa, even off-grid is included as part of that analysis. So meaning, unless technological advancements can also bring the cost of battery down, then the off-grid market is more or less like not available for CNI to kind of adopt. So I think as investors, we are of course also monitoring how the technology is evolving around batteries, and then also seeing how that will influence the CNI market. But as you mentioned, currently, the capex cost of batteries, I think, almost doubles the cost of the capex. So most customers prefer just to be grid-tied and then only benefit from cost savings. So as it stands now, it's purely an economics perspective reason to shift, and not necessarily that they want to be completely off-grid. So we still see a reliance on diesel, and hopefully over time, as the sector grows, then that can also be completely replaced. So yeah.
We have a pressing final question.
Yeah, I'll be really quick. Great session. How many years or decades off are we from seeing the big whales, sovereign wealth funds, pension funds, insurance reserves, seeing C&I as a natural part of their infrastructure allocation? And then for the gentleman from Candy, in terms of the foreign exchange risk, have you explored monoline or multi-line structures in terms of stripping out foreign exchange risk?
Thank you. Nekesa, do you want to take the first bit?
I'll try, I think we're still, let me say, a couple of years maybe away from like insurance and pension funds coming into the space. I think what we are seeing is maybe a lot of strategics, so either like utility companies or maybe oil companies that also want to go green, or or just other companies maybe in developed markets trying to enter, like let's say sub-Saharan markets. But for insurance and pension funds, most of them are very risk averse, despite the long tenure of like, a lot of the fund lives. So most of them will only either prefer like proper utility scale type, and granted, maybe C&I will get there in I don't know how many years, but very hard to speak on that, if I'm being honest, but yeah.
I think that I personally don't think it's too far away if it can be structured correctly. I mean, one of the key things about C&I is that there's a whole lot of credit risk baked into it. It's not just infrastructure. So you're buying a loan book and an asset book. So that component, and I mean, you know, we didn't touch on it in terms of the future, but I think with things like credit risk guarantees and certain structures, I mean, that could really facilitate offloading, you know, some of these assets. But you really need proof of concept around the portfolio of that portfolio risk associated with that implicit loan book that you've created. And yeah, look, on the hedging side, as I say, from an equity perspective today, given I suppose the appetite of the equity investors coming in and the structure of our revenues, we haven't looked into those. But naturally, as your portfolio grows, then the cost of you know, many types of hedging instruments become a lot cheaper at scale, and you can start getting quite smart around how you hedge that.
Thank you. Prince, any last words from you?
Yeah, maybe on that topic, right? I think in terms of C&I is still nascent, so I think there still needs to be a lot of growth around it before you see more players coming into, especially on the investment side, PFAs, etc., coming in to say we think that this is a viable model. But I will say that, I mean, on our side, one very important thing that businesses like Rentos do is really to make sure that the projects that we embark on are bankable projects. And we mirror this through everything we can to make sure that this makes sense before we get into it. So how I see the future is that, yeah, I mean, in terms of risk, and I'm saying this with the perspective of the fact that in Rentos, which I had said earlier, we have been in different spaces. We worked in the SHS space, we worked in the mini-grid space, and one thing I can say for sure, which a lot of the speakers have alluded to already, is that, you know, the collection risk is quite high, you know, when you're trying to you're building solutions to address customers in the bottom of the pyramid, in the SHS, in the mini-grid space. Profitability is a problem, okay? Now, C&I is still growing, but I think largely addresses that, and I'm saying that with a lot of context being that I've been in Rentos for a while to see how that evolution has gone and how that impacts, right? How you look at all this, okay, profitability, etc. So I think there is a path to, like I said earlier, energy independence through C&I, utility scale, hopefully, if the regulation gets better. In terms of collection risk, this is really down. Okay, you have contracts you could manage. It's clear what the cash flow is like, okay? And then, you know, bulk of your work is to just make sure you manage those relationships to make sure technology advancement in terms of OPEX, it's quite little. You don't need to spend so much time doing too many OPEX, agents on the ground. Those things we don't do that, okay? And I think it's viable. Yeah, it does take a lot of time, and there will still be more innovative PPA models that I think that will be more investor friendly as we go forward. Yeah, but really, I think this is what makes CNI special, okay? And this is what a company like RenSource has seen and has made us say, you know what, let's focus on this, let's get this done. And I think this is also the reason why you see a lot of strategics really very interested in this type of, you know, in this market.
Thank you all very much. I'm sure you will all agree that the panel really had a lot of insights on CNI. I read a report that, I think it was in 2019, that CNI will grow by, I think, 270% by the year 2030. So there's still a lot of room for growth, and we've discussed the challenges, we've discussed the opportunities. Thank you, Prince. Thank you, Philippe. Thank you, Nekesa. And thank you to all of you. The questions were very engaging. Thank you for your patience, and I will now welcome you back to your normal seats. So our next item on the agenda is the evening reception, because we will be celebrating, or we are celebrating this year Persistent at 10. So I will welcome, or the Persistent team welcomes all of you to downstairs where we were having lunch, to the garden area where we will have our evening reception. There will be more